Wall Street and mainstream financial media have a very clear message about X and inverse leverage ETFs. They are dangerous, toxic, and only suitable for reckless gamblers. They warn about volatility decay, daily resets, and how these products will destroy your capital if you hold them for longer than a day. Yet I use these exact instruments, primarily X leverage ETFs, as the core of my trading in 2025 and grew my personal account 636%. In this video, I'm going to show you exactly what leverage ETFs actually are, how they work, what Wall Street says about them, and why they can be an extremely useful and appropriate tool when paired with proper technical analysis and market structure. This is part one of a short series. Today is the belief shift. The next video will be the practical how to use them guide. Leverage ETFs are funds that aim to deliver a multiple of the daily performance of an underlying index, sector, or stock. They're typically 2 or 3x, and also inverse versions that move in the opposite direction, sometimes -1, -2, or even -x. They reset every day, which creates the daily return they are designed to track. This daily reset is real, but the way it is presented to the public often turns it into something far more frightening than it actually is. The mainstream belief pushed by Wall Street and financial media is simple. Leveraged ETFs are bad, dangerous, and should be avoided by anyone who is not a professional day trader. This belief keeps most retail investors away from a tool that can be extremely powerful when used correctly. The real issue is not the leverage itself. The issue is using leverage without a mechanical framework. Without market structure and price action as your guide, any leverage position can become reckless. When you combine 2x or 3x ETFs with clear trend lines, support and resistance, and a repeatable confluence checklist, they become an appropriate and efficient form of leverage, often more straightforward than options for many swing traders. Let's talk about the two biggest myths you hear: volatility decay and the daily reset. Yes, both exist. In a sideways or choppy market, the daily reset can cause the ETF to lose value over time, even if the underlying index ends up flat. This is real mathematics. But the way it is presented to the public is often misleading. It is portrayed as an existential crisis that makes these products unusable for anyone except day traders. In reality, when you're in a strong trending market and you're using market structure to enter and exit, the daily reset actually works in your favor. The compounding effect of multiple strong up days or down days for an inverse ETF is what creates the large gains you see in the charts. But here is the honest risk. If you randomly buy a 3x ETF without any technical analysis, you can lose 50% or more in a single bad week or even a few bad days. Volatility is real. A 10% move in the underlying index or stock becomes a 30% move in a 3x ETF. That cuts both ways. This is why so many retail investors get hurt. They treat leveraged ETFs like regular stocks and hold them through choppy or declining markets. The result is painful drawdowns and the belief that these products are bad. Let me give you an analogy that changes everything. Think of trading like flipping a weighted coin. When you have no edge, it's a 50-50 game and the house wins over time. But when you identify an advantage through technical analysis, using clear market structure, trend lines, and confluence, you can tilt the odds heavily in your favor, often to a 75 to 80% win rate on your A+ setups. On top of that, the upside of winning trades is usually much larger than the downside on losing trades. It becomes a very asymmetrical bet. For example, your stop loss might be a 10% loss, but your take profit might be a 50% return. That's an asymmetrical bet. Leveraged ETFs simply let you get more dollar upside out of a smaller initial capital outlay. The leverage amplifies your edge instead of amplifying random bets. Now, the risk here, as with buying any stock, is that you're going to want to start buying these leverage ETFs on narrative. And that's exactly what we teach in our course and in our program, is that buying on narrative without technical analysis is super dangerous. So if you bought a leveraged ETF at the very top, your account will get crushed using narrative investing. So now you understand why leverage ETFs are a core part of my personal trading. They are not a replacement for technical analysis. They are an amplifier of it. Inside the Bison Blueprint, we look for the same high probability setups we teach for regular stocks and options, and then decide whether a 2x or 3x ETF gives us the appropriate leverage for that move. If you're tired of the mainstream narrative that says leverage ETFs are only for gamblers and want to learn how to use them responsibly with market structure and price action, the Bison Blueprint Discord was built for exactly that. Inside, you receive the full confluence checklist, daily watch lists already filtered through it, live office hours, and direct chart reviews with me. Price action and market structure are the most reliable tools for any time frame. A mechanical checklist that forces confluence between these elements turns trading from emotional guesswork into a repeatable, reviewable process. The community is for serious traders and investors who value structure, process, and long-term skill development over hype. The link to join is in the description below. I look forward to seeing you inside.